This conference will now be recorded.
Welcome to the program. I'm Marty Schenkman. I'm joined by my friend and colleague Jonathan Blotmacher. Um, we apologize to any of you who viewed the prior webinar. We had Jonathan was in Alaska and had some sat phone issues that we didn't anticipate, and this is a redo. If you all remember as kids, we got to do redos. We're doing a redo, and Jonathan survived the bears and uh, did you catch some salmon at least while you were there?
Yes, I did, Marty. Had very good salmon fishing, and they were delicious, and I'm having some smoked and sent to me.
Well, if you want to share it, you know where I live. All
You
right,
bet.
everybody, let's get going. We're going to talk about a critical topic for all planners. We recognize that we get lots of people that are financial advisors, insurance consultants, accountants, as well as attorneys. So we're going to give practical advice for all of you. We're going to make sure that we touch upon what we think are some of the sensitive issues from a malpractice protection perspective, defensive practice, because it's just become very important for all the allied professions. Now, we've done webinars before, especially in 2020 when everyone was doing slats. We kind of are not going to cover all the same stuff. We're going to try to tell you how to do slats better because we've all learned a lot since 2020. We're going to talk about some of the issues that we keep seeing coming up with other practitioners doing slats that are potentially problematic and try to help you. And we'll talk about some new developments and some new techniques and so on. Now, let me give you a couple of just general quick comments. The PowerPoint is going to be available in 3 locations, as will this recording be on Peak Trust's website, on Interactive Legal website, and on shankmanlaw.com under the webinar tab. All the programs we record together on all 3 sites. All the programs I record are on my site. There's a library, not 50 of 150 recordings you can access anytime. And there's a growing library, and I hope to enlist Jonathan to do dozens more with me on Law Easy of almost 200 10-minute planning video clips. So if you want something to the point on a topic, that's there. We don't officially give CLE or CPE credits. But we do give you a certificate that's generated by the system. If you attended live, we can't generate it from a recording that's being posted. If you have any questions, since this is being done after the live recording, email Jonathan or I. Our emails are at the end, and we'll do whatever we can to help. The 2 companies besides Schenkman Law that sponsored our program are Interactive Legal. I use Interactive Legal in my practice. It's revolutionized how I practice. Every one of the techniques, and Jonathan, if you think I'm overstating, you can beat me up, but I think every one of the techniques that we're going to talk about in this program, you can get the language and draft it in Interactive Legal. So if all this sounds to some of you, oh gee, we don't have forms, or it's overwhelming, or I can't do that cost effectively for smaller clients, you can take, and Jonathan, again, if you think I'm overstating, calm me down. I think you can take almost any of the techniques that we're talking about and do them even for much smaller clients. Doctor that is young and doesn't have a large amount to transfer and really wants to do non-reciprocal slats for asset protection, you can do that planning with Interactive Legal really cost effectively. Peak Trust Company was the other sponsor. I use Peak for all but one of my own trusts. Jonathan, I know you use Peak for all of your trusts. I don't use Peak because I have an investment relationship with them. They just do a phenomenal job, and they're in one of the best trust jurisdictions, 3 of the best trust jurisdictions: Delaware, Nevada, and Alaska. And I think if you ask people to name the 4 top trust jurisdictions, at least in my opinion, I'm sure I'll get yelled at by some people in other jurisdictions, but I think historically, Alaska, South Dakota, Nevada, and Delaware were some of the top jurisdictions, and Peak is in 3 of those jurisdictions. I love being able to use a trust company where I can have trusts in different jurisdictions, different state law. And when you talk about slat planning and you want non-reciprocal slats, to me, that's a huge difference. The rule against perpetuities, Alaska to Nevada, very different. You can do it all with the same people, different legal entities. Jonathan, you want to add to that, or should I keep rolling?
Keep rolling, Marty.
Okay, I'm going to ask you to do something I know is very difficult because I know you're always bubbling with ideas. Let me get through the overview, and then you can dig in as deep as you want once we get in. I just want to set the stage. And I'm going to kind of do it quickly because there's so many details that we want to get into. So slats have been the hot item, the hot ticket, and they're going to remain the hot ticket. Why? In 2020, 2021, and early in 2022, clients and we as practitioners are all panicked. Oh my, the Democrats are going to change everything. The Sanders tax bill is going to go through. We did lots of webinars on those topics and what to do about it as that was developing. Nothing happened. Much ado about nothing. But clients were concerned, and rightfully so, because had those laws been enacted, estate planning as we knew it may have been over. So it made a lot of sense to try to get things in place, and we did tons of slats. Lots of concerns and considerations and improvements that can be made with the huge number of slats that have been done. In the current environment, unless something changes in Congress in November, and we have no idea which direction, what's going to change, I wouldn't, my Ouija board burned up and my crystal ball cracked. I wouldn't even try to predict the November election. We'll come back and do more programs planning after that if there's an impact. Maybe another set of stalemates. We don't know. I don't know that the proposals President Biden has made in his Green Book will get enacted, barring major changes in Washington. Janet Yellen has proposed making changes, restrictions through Treasury on grantor trust because of some perceived abuses and the inability of Congress to act. Don't know if that'll ever happen. And with the economy and inflation and all the other bigger issues, and I just don't know that any of that's going to get addressed. What's critical, though, is even though those things didn't happen, we have, I don't know what the number is. I haven't really seen studies, but it's probably more than tens of thousands of slats that are out there. But in 2026, the exemption's cut in half. Even though the inflation adjustments have boosted it up, it's almost going to be 13 million in 2023 per person. In 2026, it's cut in half. There's going to be a deluge of clients that have not done planning yet that are going to try to plan before 2023. Using slats as a discussion point with clients, using it as a conceptual framework for us as practitioners, great idea. But our hope is that when you finish this webinar, if you do a slat for one of your one spouse, you're going to do a different kind of trust, a hybrid adapt, or a spat for the other spouse. And even if you do a slat, you're going to do it in a much more robust way with more care and caution than was typical in 2020 and 2021. And just so nobody misinterprets it, because I know this is being recorded, I'm not saying that because practitioners didn't do their job well. I'm saying that in large part because the incredible time pressure in those years to get planning done made it virtually impossible to do the kind of care and planning. Now, and where I have comments to offer all of us and all the allied professions defensive practice tips, I wanted to really drive them home. You'll see the word in purple, protection. The bottom line, and it's highlighted in orange and purple in the bottom, offer options. We're going to tell you some planning ideas of spats and daps and hybrid daps and other things that can differentiate trusts and make them, in many cases, more robust. I would even say better in many cases. The key is you gotta offer clients options. There have been a really ugly spate of some very ugly malpractice cases. We're not going to talk about them in any depth here, but we will talk about just some of the key take-home messages. One of the take-home messages from a lot of these cases, give the client options. I suggest you confirm it in writing. Dear client, we spoke about DAPs, SPATs, hybrid DAPs, and you decided you want a simple home state slat. You understand the decision process. Send an email, save the email. You've now confirmed in writing that you've offered options and what the client has selected. You're not making the selection. That's a very protective step. Include in your discussions, even if it's brief with clients, grantor versus non-grantor trusts. Preferred partnership freezes is a potential option. And those are all fascinating topics. We've done webinars on some of them. But again, you want to offer options. The fact that slats are nearly ubiquitous in planning doesn't mean they're not without risk. Last point in purple, really critical on slide 8, warn clients of the risk. And ideally, optimally do it in writing and let them know that whatever risks you've warned them of, there's others that you discussed. In addition to all the risks that we discussed, I wanted to highlight a few of them. be careful. Now, the other point, we're going to cover 4 main topics. And once I get through this introduction, I'm going to let Jonathan let loose as he loves to do. There's 4 main reasons in this sort of typical pitch given for slats why they make sense. They remove assets from the taxable estate. You know, we have clients, their estates grow. Exemption is not only going to get cut in half in 2026, so you want to do this before the end of 25. Nobody can tell us that there's no assurance that there may not be a Democratic, a greater Democratic control at some point in the future, and they could reenact the Sanders or other tax bills that were proposed in 2020 and 2021. It may not look likely now, but no one knows. Why not use exemption as long as it's advantageous and feasible from other perspectives? The second main topic is using the temporary bonus exemption before it drops in 2026. Third is making sure there's access to all the assets, absolutely critical. There have been malpractice cases. There's one in California, Jonathan, I can't remember the name of it, but the client, I don't know if it was, I don't think it was a SLAP, but it was an irrevocable trust grantor trust. It was so successful, the client sued the lawyer because she felt she didn't have enough money. We have to be careful. We have to assure access. And that's, by the way, why we're going to give you more robust options to the plain vanilla SLAP. And the fourth point is that assets should be protected from claimants and creditor and outside of the estate. Those are the 4 key benefits that are generally talked about with slats, but that's not enough of a story. And that means you also want to talk about the other techniques we just discussed on slide 8, but we're going to go through and talk to you about some of the points that don't get addressed enough. The next couple of slides I'm going to do very quickly, and then we're going to drill down and talk to them. I'm trying to give you an overview of where we're going. So removing assets from a client's estate. Okay, great. You did a good slat. You use interactive legal, right? You drafted it. The trust works. The client made irrevocable gifts. There's no retained powers. Bam, it's out of the estate. Not so simple. You got to jump through the hoops of the reciprocal trust doctrine. We're going to talk about it, but not nearly in as much depth as we did in 2020 and 2021 programs, because I'm sure everyone's familiar with it, but we're going to give you a few comments that we think we see missed a lot. Second point, the small Dino case. If you haven't read the small Dino case, just Google it, get the case, read it. Jonathan, I think we did a webinar on small Dino. We've done so many, I can't remember, but I believe there's a webinar on small Dino on the Peak ILS and the Shankman Law websites.
There is.
Take a few minutes, folks, and watch it. A lot of practitioners dismissed it as a bad fact case. It was an awful fact case, awful facts. But you know what? It's an incredible checklist of how to properly set up and administer a slat. They did everything wrong, but everything they did wrong can be a lesson of what to do right. Take a look at it. Is there an implied agreement? By the way, the implied agreement issue is one of the many reasons I, as a default in any plan that's more than modest in size, want to use an institutional trustee. How do you have an implied agreement with the trustee? Point of number 1 that I've just talked about very quickly, and we'll drill down in a minute, is it ain't so simple to assure that the assets are out of the client's estate. It's not just the trust document. It's how it's funded. It's how it's administered. Lots of stuff. Second, clients want to secure their temporary bonus exemption. We're going to go through, but I can tell you a large proportion of the slats I see done out there are done in a way that is not, and I hate to use absolute terms, optimal, but they're just not done in what I'll call the best way. And I hate to use the word best because what is best, but we're going to explain some of the things that need to be addressed. And by the way, these huge inflation adjustments to the exemption, even clients that did all the planning they thought they'd ever do in 2020, you want to call them. Now, third point, access. I put the word major in caps in the bullet point on slide 11 because many of the slats that I see, many of them that I've done over the years, don't give maximum access. I don't quite know what the word maximum is. Again, I hate using absolute terms, but there's an awful lot that could be. My slats that I did for my wife and I, if I did them today, I would give much more access than I did back then. Let's talk about that because that is absolutely critical for clients. And we're going to talk about things other than just the legal drafting that are critical to protect access and make sure clients don't have a problem. Critical. Fourth point, creditor protection. Great benefit from slats. I said earlier that you may have, for example, a physician client, but everybody should be worried about asset protection. It's not just taxes. not just reciprocal trust doctrine issues. It's trying to do the planning and the funding in a way that helps protect it from claimants. You can have the best SLAT document in the planet. I don't know what that'll look like, but the best SLAT document in the planet, if the client doesn't administer the trust right, it may not withstand an attack by a creditor. Jonathan, I don't know about you. You practice more than a couple of years, and from my old gray beard, I've been around the block. I kind of ponder, every time a client finally gets back in, and we tell everyone, and it's I think emboldened and underlined in our engagement letter, that you got to have an annual review. These are not simple trusts. Warn clients. If you're a financial advisor or an accountant, if you're doing a 1041 as an accountant, you're doing an asset allocation and IPS as an investment advisor, and it's a SLAT, drag them back to their attorney. And it can be done on Zoom. You don't have to physically drag them, but physically drag them back and get an annual review meeting. I can't, every time I think I've seen the most ridiculous thing that a client has done in not administering a plan correctly, I see somebody come back in with something that tops it. One of the things, and we've seen a trend, and it's really scary and worrisome, it's really hard to know what to do about it. A lot of our clients have in-house CFOs. I don't know what phrase or name. It's if they don't have a family office, they have like a family CFO, if you will, that handles lots of the trust administration and other things. And we keep catching and finding that these people decide, oh, the lawyer did a direction letter, we'll just mark it up and use it ourselves. The stuff they've drafted, awful, contradicts everything in the trust. Crazy stuff. They're going to unravel their asset protection planning, I fear, if a creditor gets a hold of this. So we got to talk about that. Now, Jonathan, I'm done with my overview, so you can interrupt me all you want and you can talk all you want. Now, I just wanted to give everyone a high-level overview of what we're going to cover in the approximately 90 minutes that we have. Now, so let's dig in, and our first topic is getting assets out of an estate when you use slats. Really very important. And there's lots of issues. You got implied agreement attacks, you got the reciprocal trust doctrine, ruining the administration of the slats, all kinds of bad stuff. Jonathan, you want to make any general comments about trying to get these things respected so the assets stay out of the estate, or some of the mistakes you've seen people make?
Well, Marty, I think the number one adage that people can keep in mind is that the taxpayer gets the lesser of form or substance. So first, you've got to have great form, but you've got to take a look at the substance, which means you're going to look at the actual administration. And as Marty indicated, if your administration is faulty, you're probably going to lose big time. There's a very famous case involving charitable remainder trust that came out of the 11th Circuit, where the taxpayer had a perfect trust in form, followed what the IRS said. If you follow this form, you'll have a good charitable remainder trust. But at the end of the day, because there weren't distributions to the client, the tax court and then the 11th Circuit said it was not a good charitable remainder trust, lost the deduction and lost the tax exemption. So, administering these things properly is critically important. And as Marty said, one of the things you want to do is to consider having a professional trustee, because if the professional trustee screws up, well, maybe they're going to be liable rather than you losing all of the benefits of what you've tried to do. But I've had people who have come to me and said, yeah, we made a terrible mistake, but it was your fault, Jonathan, for allowing me to be a trustee, even though the family said we want brother George or sister Sarah to be the trustee. They have a master's degree in business administration, and I'm not making it up, it's an actual case where when it looked like the IRS might come in because there had been a misadministration of the trust, he said to me, Jonathan, it's all your fault because you knew I wasn't competent to be a trustee. Go figure. So one of the things that I began doing in my letters is we send out the final draft of the trust when it's been signed, is to say, by the way, we are not going to be involved in the administration of this trust, except to the extent that you re-engage us to do so. That's, again, one of the protective things you can do. I know that sounds silly, but it's going to protect you when you're not the trustee and you don't have a professional trustee and something goes awry.
By the way, I'm doing a webinar on this topic. I pay institutional trustees on every trust I have, except my revocable trust. Every irrevocable trust I have in my family has an institution. To me, it's an inexpensive insurance policy, and Jonathan's only touched on one of the reasons. To me, the implied agreement issue always concerns me. If I have my sister as a trustee, hey, sis, send me a check. Sure. She won't do anything else right. If I call her and ask her to do something, she'll do it. There's, how much independent administration is there?
Well,
Get
indeed,
it.
Marty, you mentioned this Small Dino case, and in the Small Dino case, where Mr. Small Dino gave property to his wife, who in turn gave it over to trust for her husband's prior children from a prior marriage.
Right.
She, on the stand, said she felt she had no ability other than to transfer it over to the kids. I mean, they were dead in the water at that point. But if you have an independent trust company, you can go ahead and insure it. No, we didn't have an understanding that we would do whatever Marty asked us to do. And in fact, one of the things you possibly do is to set up a trust with, say, an individual as trustee, but have that individual resign in favor of the corporate trustee. Because the corporate trustee won't have been around when the trust was actually funded, you should be very, very protected from an argument by the IRS or a creditor that there was an implied understanding.
Very important, folks. I don't want to cover it now. We're going to cover it later. But financial modeling, a proper insurance plan, I think, are critical to negating, deflecting some type of implied agreement. There is no implied agreement. Here's the financial modeling done when I did the trust. I didn't need that money. I didn't need an implied agreement. An insurance analysis by an independent insurance consultant that shows where some of the financial gaps are, and we'll go through this in a few minutes in another slide, to me backstops everything we're doing. When you do that, I do want to address one point here. Make sure that the team, all of us advisors, is involved and the client doesn't go to the financial advisor without the attorney who designed the plan and maybe even the accountant. And when I say go, it's a phone call, a Zoom meeting, whatever. Because I've had a situation where, and of course it was a doctor client who didn't want to listen because he knew better and he was going to save 15 minutes of my billable time. I don't think it would have been more. So he went to the financial advisor and said, I'm giving away 10 million bucks. The lawyer wants some kind of financial model to prove I can do that. So the financial advisor is a smart person. What did they do? They said, all right, you're giving away 10 million bucks. You're never going to have access to it. And they used some fairly conservative assumptions to make sure that he had enough money left. And what did they do? They came back and said, you can only give away $1.2 million. I didn't want that in the file. The doctor gave the wrong information. This wasn't going into a kid's hands and could be dissipated. This was going into a slat. I'm sorry, a spat, which we're going to go through if you're not familiar with it. It was going into a spat where his wife was a beneficiary. He could get access through a special power of appointment. There was a loan provision, a tax reimbursement provision, ability to hold personal use assets. The house, by the way, behind you, right here, that's owned by an LLC that's owned by two Alaska and one Nevada trust, broken up so nobody even has more than 30-40%, I don't think. All right, so you can have lots of ways to get access. The financial advisor was not wrong. He was given wrong facts. So you want to make sure the team is on the same page when that analysis is done so that it's done well and backstops what the plan is. Protection for you as an advisor. Add cautions to the client memo. What we've started to do is we have template letters and memos that list a lot of the issues that are common to different types of plans. And when we send out a draft of a document, standard letter. When we send out a proposed final copy, standard letter. When we send out the signed copy, the original, because we don't keep originals, we're paperless, standard letter. And in each of those letters, we caution the clients about different things. And by the way, we just added a change to all of our standard letters, which I think is almost obnoxious, but one of the recent malpractice cases, which I find deeply disturbing, and I shouldn't say much because no, I'm not in the case and don't really know the details, but everything I've read about it, I find deeply disturbing. one of the claims by the client was, golly, the lawyer drafted a trust that wasn't asked for, stuck it in the middle of a whole bunch of documents, and the client signed it without understanding it. I don't know how that can be. And when you have very uber wealthy people, I think they need to be held to a higher standard of awareness and knowledge of this stuff than the Susie Orman client. It's just not fair. It's not right. And the person, not only the name of the trust had the initials of the kid in it, and they initialed every page of the trust. How could you not know you were signing a trust? It just doesn't seem plausible. So what did we do? Every document that we now cover letter that goes out has in bold and caps, do not sign any document if you haven't read it in its entirety and understand it. It's your obligation to let us know if you have any question. And when we send the final documents out, the signed documents to the client, that cover letter says, you informed us that you read and understood every document you signed, and if you do not object immediately to us in writing, your acceptance of these documents in this cover letter reconfirms that you signed everything. I don't know if that's the right magic bullet, but we got to protect ourselves. You know, we all work under tremendous pressure. And even those of us that charge big fees, like Jonathan, our fees are inconsequential compared to the amount of assets we're involved in. The clients have to assume some responsibility for this. So keep that in mind. You got to protect yourself. Now, how to plan a slat to succeed. Jonathan, you want to go through some of the things from the reciprocal trust doctrine, but let's not dwell on it too long because we got, bigger fish to fry.
Well, it's called a slat because it's a lifetime access trust for your spouse. This is not going to qualify for the marital deduction, and in fact, you want to ensure that it's not in the form of a so-called Q-tip trust, where maybe, just maybe, someone will claim, well, it really did qualify for the marital deduction, even though you're supposed to put it on a return and actually elect for it to qualify under 25 under the gift tax rules. So again, you want to, in fact, in my slats, I would say, we know that this will not qualify for the marital deduction. But it's a trust for your spouse, but you can also include every other descendant or every other loved one you have. So if you're supporting your mother or your father-in-law or someone else in the family, you can go ahead and make the trust not just for your spouse, but also for other people. When my wife and I did ours, actually, I was not permitted to receive a distribution for 5 years after the trust was created, and it provided that I was really only a secondary beneficiary. But the one I did for Betsy, I said she should be considered, although it wasn't mandatory, to be considered the primary beneficiary of her trust. And I gave her lots of additional powers of authority, which I didn't get. So it's for your spouse. It's not going to qualify for the marital deduction. And in theory, at least in every state of the union, because your spouse's interest presumably is going to be discretionary and not mandatory, in some jurisdictions, yes, you can give your spouse a right to take property for her health, education, maintenance, support. And in some states, there's an explicit statute in New York, for example, which says that's not going to make the assets in that trust subjected to the claims of the creditors of the spouse, the beneficiary. But I like a discretionary trust. So you put in as a discretionary trust for your spouse and for your descendants, and you can put in precatory language that I hope the trustees will consider the interests of my spouse more important than any other beneficiary. But make it clear, and you're going to want to make sure they're not reciprocal trusts. Now, how do you do that? Well, again, there are several factors. One is, do not have the trust be identical. Maybe if you're going to create one, Marty is going to create one for Patty, Patty's going to create one for Marty. If you can wait a lot of time, even to another year, that's a good fact. Second is, use different assets. The cases which taxpayers have lost big time, like the Estate of Grace case, which was decided by the Supreme Court in 1969. And by the way, for those of you of the Catholic persuasion, that's Estate of Grace, not State of Grace. But anyway, Mr. and Mrs. Grace created identical trusts for each other on the same day with the same lawyer and the same assets. And they were identical. And the Supreme Court had no trouble when Mr. Grace died saying those assets were includable in his estate because he had an income interest. That brings up the fact that you should make the spouse's interest discretionary. Because if it's mandatory and they do switch the trust, so Patty is treated as though she created the trust that Marty created for her, then because she's got an income interest, section 2036A1 is going to apply. And also state law is going to say that that income interest can be attached by her creditors. So you want to make sure that you don't have that. You want to have discretionary interest. And I would suggest you not at least make both of them HEM standard. So, and don't allow the spouse to hold that HEM standard. So for example, in the trust that Betsy created for me, for the first 10 years, once after 5 years, and I come in as a beneficiary, I can only get distributions under a health, education, maintenance, support standard. Whereas the trustees can give property to Betsy for any reason or no reason at all. Also, a very important case is the state of Levy, which was decided basically in New Jersey by the United States Tax Court. Mr. and Mrs. Levy created identical trusts for each other using the same attorney, same trustee, same standards, say everything, except that Mr. Levy gave Mrs. Levy a lifetime broad special power of appointment. The IRS conceded that if that power of appointment were valid under New Jersey law, which governed the trust, then the trust would not be considered reciprocal. And the court adopted that since the IRS conceded it. And I've often used that, but I wouldn't rely on it alone because it was a concession for that case. So sure, give one spouse a presently exercisable special power of appointment. Don't give it to the other. That's what I did for Betsy and she didn't do for me. But try to make that difference as well. So different terms of the trusts, different entitlements, different powers of appointment. And one other thing is removal. I gave Betsy the ability to remove and replace the trustees anytime she wanted. I have no such ability. Now, if I wanted it, of course, at a later time, maybe we could decant the trust that Betsy's created for me and give me more powers. We haven't had to do that now, and we actually did these trusts over a dozen years ago, and I feel pretty confident that the reciprocal trust doctrine just could not apply. Again, we used different trustees, we used different standards, we gave the wife much more power than the husband got. In fact, again, for the first 5 years, I wasn't even eligible to receive a distribution, and we used different assets. As much as you can, make them different. One of the problems is the clients come in, they want action right now, or you're up against a deadline. Like we thought, things might change in 2022 because of proposals that the Biden administration had made to basically reduce the exemption beginning this year. Now that didn't happen, but it could happen in another year. If the Democrats win the midterms, and especially if you get one more Democratic senator, so Joe Manchin and Kyrsten Sinema can't block it, I think you will see another run at reducing the exemption, and you may have very little time to act. So now is the time to think about creating at least one of these slats and not the other. And we're going to give you other things as well.
Let me make a couple of comments and ask Jonathan a question. One, I want to emphasize a point Jonathan made. I think it's very important. Don't rely on the Levy case, or Levy, however you pronounce it. Get multiple differences if you can between the trusts. I like putting them in different jurisdictions because I like using trust-friendly jurisdictions. I think they're better than New York and New Jersey, where I primarily practice. I like institutional trustees. My wife, Patty's trust is in Nevada with Premier. My trust is in Alaska with Peak. Different trust companies, different state law. That difference in state law between some of these trust-friendly jurisdictions, Delaware versus Alaska, South Dakota, et cetera, pulls into the trust a lot of differences. So I think that's another great way to differentiate trusts. And I think from an asset protection perspective, especially if you have entities fractionally owned by the various trusts, is a great way to plan. And that's a prelude to the fourth section we're coming to. Jonathan, let me ask you a question.
Well,
so
Marty,
let's say somebody.
Let me just expand on one of the things you said. You said, you like to use jurisdictions that allow self-settled trusts. And here's the reason. Let's suppose that the local judge, or let's suppose the IRS comes in and says, these are reciprocal trusts. And therefore, Patty is treated as though she created the trust that Marty actually created for her. Well, if that trust is in a jurisdiction like California or New York, That means it's going to be self-settled, which means it's going to be subject to the claims of the beneficiary's creditors. Well, if that trust instead had been created in Delaware, South Dakota, Alaska, Nevada, then even if it is self-settled, she still would not have an entitlement to it. So you can avoid perhaps a claim by the IRS that it's includable in her estate under 2036A1. So again, go to different states, or if you're going to go to the same state, make sure that the state or states involved allow self-settled trust legislation. As we now have, I think it's 18, Marty, which allows self-settled trust to be protected from the claims of the settler's creditors.
Let me tell you something that concerns me about Slat. So husband and wife each set up a Slat and put 10 million bucks in it. Most clients, not me, most clients have joint checking accounts. They just do. They mix everything together. So let's say, and I'm going to use husband and wife because it's spouse one, spouse two is too confusing, so forgive me. But let's say husband gets a distribution from wife's Slat. He's a permissible beneficiary, no problem. What does he do with that check? Puts it in the joint account. What does wife do Sunday afternoon? She takes out the joint checkbook and she pays all the utility bills and the cable TV bills and whatever else, property tax for the house they're both living in. She's not a beneficiary of that trust. Did she not just benefit from that trust? Is that an issue? Never seen it come up, but it concerns me. That's why, just to echo Jonathan's comment, I really prefer being in a self-settled trust jurisdiction. We routinely do, and you'll see it at the end if we get to the end, that I do solvency affidavits, which Alaska requires for a self-settled trust. It ain't a big deal to do, it's protective. But now I think I have a better argument that I've kind of complied with the requirements of Alaska for a self-settled trust. Let's go on. Now, let me ask you a question, Jonathan, that I think is important. Let's say somebody's listening to this and says, oh my, I had a couple of clients that were just really penny pinching, and I took husband's trust and I flipped it, changed the names for wife. I put a different trustee to make it different, and I added a mother-in-law as a beneficiary. That may or may not be enough difference, and they're all in the home state. Can they go and decant one of the trusts and change it? That obviously they can. But if they go and decant one of the trusts to add some differences today, might that be useful, or is it kind of not going to help the past sins of being too reciprocal?
Well, Marty, that's a great question. I don't think it necessarily eliminates all of the prior sins, because the question is, were these trusts created in reciprocity of each other, in consideration of each other? That's the test that the Supreme Court put on. I think what you have to do is you have to break down the interests of at least one of the spouses to a de minimis thing. So, for example, if the trusts are essentially the same, yeah, you've got some differences because you put in, Marty, the mother-in-law on one and not on the other, or you put in a different asset. I don't think if you've not done it from inception, you got it. But maybe what you can do then is to have, say, the trust that the wife has created for the husband decanted so that his interests are really minimal. He's not entitled to anything. He has no power of appointment. He's been basically just picked to the bone of his rights. And I think in that case, that would really help, especially if you are in a self-settled trust jurisdiction. Because again, what happens is the IRS argues that the trust should be recrossed so that the trust that Patty has created for Marty is really one that's treated as though Marty had created for himself. But again, if you're in a self-settled trust legislation state, and by the way, you can move to one and probably get protection, then you have an argument, no, because Marty's interest is purely discretionary, and under local law, there's no entitlement. So even if you say that the trust that Patty created for Marty will be treated as though Marty created it for himself, at least from an estate tax perspective, you stand, in my judgment, a pretty good chance of keeping it out of Marty's estate.
Just to be fair to all of us, because I know this is being recorded, all of us did trust with far less attention. And I know that somebody's going to argue and say, no, I always paid attention to the reciprocal trust doctrine. My belief and experience is that the vast majority of practitioners did not give the attention to the reciprocal trust doctrine years ago that we do today. So all of us have in our practice, I would suspect, a lot of trusts, old cuprits, old islets that are too reciprocal. Whether or not you want to decant them and change them up, I don't think there's any law that says it works. I think Jonathan's point is reasonable, and that, it's not clear that it's going to address past sins. But you know what? I'd rather have a trust that's different today going forward than a trust that remains reciprocal.
Well,
So just a thought.
indeed, Marty, I think you get a couple of real benefits from it. One is if the examining agent looks at it, he's going to, or she's going to see different dates on the trust now. Because you and Patty did yours, let's say, in 2005 for each other. But now the one has been decanted and it's going to show a date of maybe 2022. Wow. Now maybe the examining agent will dig further. Where did that come from? How did it happen? But again, if you've moved it to a self-settled trust jurisdiction, I think you really helped yourself avoid it tremendously, having it come up. So, that's one of the things that can be done. The other thing is that you can decant to a trust which someone else has created. So maybe we have Marty's mother create a trust for Marty, which Marty likes. But what we do is we then decant the assets from the trust that Patty created for Marty over to the trust that was created for Marty by his mother. So when you look at them, they don't look reciprocal at all. Now, again, you go behind the scenes, you can find out where it came from. And one of the factors to keep in mind is what is going to be the income tax status of the trust. Normally, if Marty creates a trust for Patty or she creates one for him, they're going to be grantor trusts with respect to the grantor. But if we're now going to add assets that Patty put in trust for Marty to a trust that Marty's mother created for him, well, it's not going to be a grantor trust with respect to Patty, which may be just fine. But you have to think through the consequences of doing a decanting where you're going to have a different grantor.
All right, I'm going to speed up a little, folks, because we got a lot to cover. And as always, Jonathan and I banter about ideas that come to us, which I think is interesting and helpful, and I always learn something. But let me try to catch us up a little. One of the issues, and this certainly was highlighted in the small Dino case, but it's not rare. And to be blunt, all of us violated these rules, I think, in 2020 and 2021 because it wasn't our fault. It wasn't the client's fault. Congress was talking about retroactive tax changes. People had to move fast. But I think it's important, especially now, and whether you go back and address something that was done before on a gift tax return you're filing now is another discussion. But gifts and transfers between spouses are very important. In the small Dino case, husband transferred LLC interest to wife. She held them one day and transferred them on. The Holman case seemed to recognize 6 days as being meaningful. Bottom line is you want time to pass if there is a break of joint property or husband or wife's property to the other spouse. I like to do a gift letter so we're acknowledging the date that was broken and that the other spouse is relinquishing any interest in it. I like to report these spousal gifts on gift tax returns. You don't have to. There's no Q-tip election on a simple gift, but listen, we're being upfront. We're reporting it, and perhaps it tolls the statute of limitations. Have the assets not only in the donee spouse's name for 30 days if you can, 60 days, the longer the better. Right now, I mean, if you're doing a significant transfer, why not wait till next year before the donee spouse makes a gift? Another point, it's not just time, but it's what's done. If husband gives wife cash, have wife go out and hire a new broker at a new brokerage firm and create an investment policy statement with the new broker, investment advisor, and invest those assets, start a new asset allocation. Lots of things. Lots of attention needs to be given to step transaction. Now, drafting the slat we've talked about. Here's a point that I want to make that's significant. And I think it's important to think about and advise clients if you can put it in writing, if you can add it to a standard letter, if you have one that you use for slats that you're making non-reciprocal, you might want to do that. Here's the point. Jonathan gave you lots of ideas how to practically draft to differentiate the trust. And by the way, if you're using document generation software, you can pick pre-selected answers where a lot of those differences are already baked in. It makes it much more efficient. Here's the point to caution clients about. If take a look at the plan. Think about the plan Jonathan said he did with his wife. And I think it's great that he was willing to share his plan. And I've done that too, because it makes it much more real. He may not have a power of appointment over the trust set up for him that his wife has over the trust set up for her. He may be limited to a HEM standard. She has a broad standard, et cetera, et cetera. There's real economic substance to that. You don't want to find that years from now, one of the spouses comes back and says, hey, my wife or my husband, they can do this, they can do that. I can't do any of those things. Why'd you give them all the benefits? Make sure clients understand this is not just a game to play where you're waving magic wands and making trusts different for tax purposes. There's real economic consequences to many of these powers and differences. Important to note. Very quickly, because we have a whole program on the Kastner case and state tax planning, think about non-grantor trust. You can do a slant spousal lifetime access non-grantor trust. You can minimize your contacts with a high tax state like New York and California. And I think New York now beats out California for having the highest local tax rates if you're in New York City, but they're both really costly. Think about what that type of planning may want to do, because that can be useful. And even if you're going to do a grantor trust now because you need to, think about the kind of planning you can bake into the trust. So when the client turns off grantor trust status, whether it's on death or proactively beforehand, you may have the ability to save state income tax. Another point, the whole point to slats and the whole thing we're talking about is getting assets out of the estate. Put in writing. I'm not saying it's a standard of practice, but to protect yourself, because some of these recent malpractice cases, these very wealthy clients claimed, golly gee, the lawyer never told me I wouldn't get a basis step up. Golly gee, the lawyer never told me I'd be paying the income tax on trust income. Put some of this basic stuff in writing. Recent malpractice case, the client said, golly, they changed the trust from grantor to non-grantor, which I like and I wanted, but they never told me that I was giving up my swap power. I want the assets back that were in the trust. I struggle with all this. The clients with the kind of wealth that we're talking about can argue that they had no idea. I struggle with it because, in my experience, I can't say all, but a large proportion of clients of that financial range have sophisticated accountants and sophisticated general counsel. They often have fairly knowledgeable in-house bookkeepers and other people, wealth advisors, trust officers. They have a bevy of people around them that would also be able, and probably did, I think, explain these things. Put it in writing if you can. Protect yourself.
Marty, let me add, you said, if you put these assets in a trust, it's not going to be includable in either spouse's estate unless you're foiled perhaps by the reciprocal trust doctrine. You don't get any step up in basis. In the September 2002 issue of the Journal of Taxation, and you just might want to write this down, Mitchell Gans, Hugh Jacobson, and I wrote an article, and one of the things we covered is what is the basis of an asset that's in a grantor trust once the grantor dies and grantor trust status is turned off by reason of the grantor's death. I'm not going to go into the detail, but we made, I thought, a very strong argument that you nonetheless got a stepped up basis under Section 1014. That was in 2002. In 2009, the IRS came out with a chief counsel advisory opinion saying you don't. They didn't give any reason, it just said you don't. But in 2012, the IRS issued a private letter ruling in which they said you do get the stepped up basis. The service then was inundated with people saying, I want a ruling that my client gets a stepped up basis when the client dies and grantor trust status is turned off of the trust. And the IRS said, we're studying the matter, and it's still studying the matter. But one of the things you might think about if you think, well, Paul Walker, you Gans and Jacobson are out of your mind. That's a legal impossibility. Well, the beloved Bernie Sanders last year put in a bill in which he expressly stated no step up in basis if that grantor trust was not includable in the grantor's estate. There's a very strong argument to make, and in fact, Representative Pasquale from New Jersey wrote a letter to Janet Yellen about 6 months ago saying, you've really got to take care of this by a regulation. So that's where the matter stands. But the better thing to do if you have a grantor trust and the grantor is about to die and you would like to get that stepped up basis is actually swap the highly appreciated assets, better yet cash, into the trust for the low basis assets. The low basis assets now received by the spouse, and it can be either one of them, tax-free, because you can't have a transaction with a grantor trust according to IRS Revenue Ruling 85-13, and also that will apply under Section 1041 with respect to a spouse, a trust your spouse has created. So you can take a look at that, but what you can do is to substitute other assets in. And you can do that the day before the client dies. Those assets will then be owned by the person who suddenly dies, and they'll get a stepped up basis. And there's no like 1 year rule that you're denied a stepped up basis when you do it that way. Important thing to keep in the back of your mind. I promise that somebody who is listening to this webinar will have that issue come up in the next year. And the best thing you can do is to make sure that they do a swap of high basis assets that they own for low basis assets that are in the trust, entirely income tax free. And they also, or it can be the spouse who does it, and then you will get the stepped up basis because they're going to be owned by the decedent and not by the trust.
To make that work, folks, we need clients to come back and talk to us. We need periodic review meetings. We need a team. If it's investment assets, we need to be talking to the wealth advisor, and the wealth advisor needs to be talking to us. Lots to talk about with that, but let's move on because we got a lot of ground to cover. A couple comments on slide 22 on insurance. And we're going to cover some more insurance issues coming up. So Jonathan, hold off if you're going to add something because we got more coming. But let me make a couple of points on slide 22. One of the things we've done a lot of is we put insurance provisions, and I'll tell you what I mean, into slats. Slats are really not that different from insurance. One of the issues that comes up is many clients have business assets and want to be the investment advisor or investment trustee on a slat, and that's fine. It's not a tax sensitive power. But if you're going to have life insurance on that individual's life under 2042, you don't want them to have any control over the insurance decisions because now you have an estate inclusion issue. So we always appoint a separate insurance trustee and provide, and you may want to provide that the client, the settlor, can never serve as insurance trustee. It doesn't take that much more, and you can throw in some boilerplate insurance provisions. Bam, the SLAT can be a very powerful ILET. Why? Because it's already GST exempt, it's long-term, it's probably better drafted than the old style ILETs we have. And the clients, if they're trying to safeguard exemption, put many, many millions of dollars into the trust. So you got a trust that mimics the ILET, probably more modern, better, longer term provisions. And there's plenty of money in it. So there's no need to make annual gifts. There's no need for crummy powers. There's no need for another trust to hold insurance. It can all be done in the SLAT. Clients love it. Insurance agents love it. They love it. They love it. Another point, what we've done with a lot of our clients, especially after the dust settled after 2020 and 2021, because it was just insane with everyone rushing. And we may see all that again in 2025. And you know, I didn't say it, Jonathan said it. And, you know, who knows? I mean, if the Democrats get just a couple more votes in the Senate after the November election, I'm not predicting anything, no idea. But if they did, gee, they may very well revisit this and try to push through the Sanders tax proposal or Pasquale or one of the other proposals that was out there, Biden's Green Book. You know, we'll be all back in the fray again. But by 2025, at the end of 2025, the exemption's going down. We're going to be back. Anyhow, when it got a little calmer like now, I guess it's maybe the calm between the storms, take these old ILETs and look at them. So many of the old ILETs, the clients are still making annual gifts, supposedly issuing crummy powers, and I'm not going to say how many clients actually do crummy powers correctly. Any? You know, but if you can take the ILET and get it into, and I'll explain two quick ways to do that, into the SLAT, there's no need for annual gifts, no need for crummy powers, a trust that you know, many of these old style ILETs paid all the money out to the kids at age 30. Now it goes on forever. You've just really enhanced the planning for the client. You've eliminated the annual gifts, the crummy power rituals they all hate, all clients hate it, and you've given them a much better trust. How do you get it in? You may be able to merge the ILET, decant it into the SLAT. One of the issues that comes up, a lot of these old style ILETs were never GST exempt. So you may want to do a late allocation of GST exemption. For wealthy clients, they probably want to use their GST exemption in better ways than this, or may have already used it all up. For a lot of our clients, come 2026, the exemption, GST included, is going to be cut by half. A lot of clients that are even fairly wealthy have lots of excess unused GST exemption they're never going to use. Why not use it to make a late allocation to an ILET and then decant the ILET into the SLAT, get rid of the old trust? You've given them a great enhancement, real value add to planning, and clients love it. If that approach doesn't work, another approach that may work better in some instances, if the ILET's a grant or trust, which if it can pay, and I'm not going to get into it, but most people will argue it's a grant or trust if the trustee can use income to pay premiums of life insurance on the life of the settlor. It's not 100% clear, not our discussion today, but is a grant or trust if the ILET sells the policies to the SLAT, which is also grantor to the same settlor insured. You've now got all the insurance policies in this much better trust. You get a note back. What do you do with the note? In a number of cases, we've distributed the note out. People have excess exemption. We've had the spouse who's the beneficiary take the note and give it to her or his ILET. Bam, we got rid of a not so great old style trust, simplified the planning. Everybody's very happy. We're going to talk about insurance in some other ways, but there's a lot of insurance planning that can be done with ILETs that's creative and very helpful.
Marty, let me mention one thing that I'm going to make at least a few people who are listening to this unhappy. You've had a lovely couple come in as clients and they both work, and you ask, do you have any life insurance? And both the husband and the wife do have life insurance. And the lawyer says, oh, we're going to put them in an ILET. Makes great sense. But if those trusts are then done at the same time, which they probably will be, you're going to wind up just in, right in the buzzsaw of the reciprocal trust doctrine. So Marty and Patty come in and I say, do you have life insurance? Marty said, yeah, I have some. And Patty says, yeah, I have some. Well, we got to put him in ILETs. Well, again, if you do the standard ILET, same for the husband and same for the wife, you have walked into the buzzsaw of the reciprocal trust doctrine, and you better go back and change some things. And Marty, I'm confident that there are people listening to this who have had that experience.
Absolutely. I like the idea of selling the insurance because now the old trust is gone. Anyhow, I skipped through some of the stuff on differences on reciprocal trust doctrine. The information is there. I don't want to belabor it. It takes a team to administer a SLAT. You got to administer them properly. Look at the small Dino case. Let me run through some of this quickly because it's more detailed than I think we need to go through, but I want to make the points and you can go back and refer to the slides. I can't tell you how many times we have clients that make transfers using defined value clauses, Wandry, Petter, Christensen, whatever. But the problem and the point I want to make here, first of all, and the IRS non-acquiesced in Wandry, and I think, Jonathan, you indicated that you've heard of some settlements going on. The IRS has continued to attack these. That's another discussion. The point I want to make, and Jonathan said it right up front, the taxpayer gets the lesser of form over substance. If you have a valuation adjustment clause, I gave 10 million of a family LLC to a trust to use up exemption, and then you do everything wrong, which too many people do, and I see it all the time. On the gift tax return, the accountant filed the gift tax return, never sent it to the lawyer. Instead of saying that 10 million worth of LLC interests were given to the trust, they say 50% interest. Now they've completely contradicted the valuation adjustment. On the income tax returns, even if it's a statement for the trust, done wrong. On trust company records, a lot of times you have a clerk that's just inputting stuff. They see 50%. They don't want to go and figure out what to type, that it was really 50% as a administrative convenience and an estimate based on an appraisal that's subject to a valuation adjustment mechanism under whatever document. You got to make sure that this stuff is reflected properly everywhere. Client personal financial statements. I just got a client personal financial statement that completely contradicts everything that we did. And I put in writing to the client, you can't do this. Focus on all the practical implications of carrying out the trust terms and constructs through everything the client's doing. If the IRS sees stuff on an audit that's contradictory to what you've done on the trust, like Jonathan said, form over substance, where are you going? That's not even getting into the technical details of Wandry. You didn't respect it. Why should we? Very significant issue. The only way this stuff is going to get discovered is periodic, I think annual meetings at minimum, team collaboration, because you need the accountant, the attorney, the wealth advisor, everybody's got to talk. Consider some of the options and protect yourself. That's noted. The Nelson case, don't get creative in your writing of these valuation adjustment mechanisms. Make sure you talk about gift tax values finally determined. Taxpayer got nipped in Nelson. If you're an accountant and you're filing before October 15th gift tax returns, take a look at what was done in the valuation adjustment mechanism. Nobody likes to correct something after, but we talked about this in the context of the reciprocal trust doctrine. I'll talk about it with defective transfer documents or anything else. Tell the client you can't guarantee anything, but boy, I'd much rather have a client sign a corrective document, signed today, dated today, no backdating. That is verboten. But sign a document today correcting the Scrivener's error or the other issue that wasn't done right. At least if there's an audit, you have something to show them. You at least show good faith. Everybody has foot faults. When you read the Small Dino case, all of us have tripped on some of the same foot faults in Small Dino. How many foot faults do you need, Jonathan, before the IRS won't have mercy? There's no answer to that. You know, it may depend on whether you have a good-looking attorney like Jonathan representing you or an ugly, you know, gray guy like me. I mean, you don't know what's going to take, but you want to minimize every foot fault you can because there's no magic number that you're allowed. It's not like you get two, you know, get out of jail free cards when you play Monopoly. You don't know. So you want to address all these things. And that's why you got to get the team involved. I can't tell you how many clients like, oh, I don't want to pay for you to talk to the accountant. Well, how's the accountant going to fill out a tax return if I can't sit and explain the trust? You shouldn't talk to the trust officer. You don't need to. They're getting paid. Well, but if I don't sit down and spend an hour or two, whatever it takes, and walk through the trust and explain some of what was done, is the trust officer going to understand that? I can't tell you how many times there's a mechanism, and it's not for today's conversation, that Jonathan, I think you created it in some of the documents, where if there's a valuation adjustment, it flips into 90% into an incomplete gift trust. But I can't tell you how many times clients don't put the transfer documents the corporate counsel does. They never read the trust document. It's not done right. It goes to the wrong trust. You
Yep.
got to look for all these administrative things. Let's move on because I want to get into out of the administration and into some of the other things. Let me make one quick point for point number 2. You want to use slats and slat-like planning, which we're going to get to secure the exemption. One of the problems that I see is so often clients of more moderate wealth should perhaps only do one trust, and I'm going to give you a spin on that in a second, but instead do 2. If you have 2 clients that put $4 million each into a slat, they've wasted their time and money. Maybe. I mean, maybe not, because maybe they're both physicians and they want asset protection and that's the primary purpose. Great plan. No fault with that. But if the goal is really to use exemption and the exemption is going to get cut in half and the bonus exemption is going to disappear in 2026, barring a change in Congress, and we can't predict that. We can only work with what we know. If they have 4 million or 5 million in each slat, they've accomplished nothing because the exemption comes down to 6. They each get 1 or 2 million of exemption left. They've safeguarded nothing extra. They haven't safeguarded a nickel of bonus exemption. If they can't give the full 12,060,000, it's almost 13 million in 2023. That's fine, but think about one spouse setting up a trust. And by the way, this is a lead-in, which don't do it yet. Why a SPAT or hybrid DAPT or DAPT is so much better. But and we're going to come to that, folks. But maybe better for one spouse to put the 8 million in a trust. So if the exemption goes down to 6, they've safeguarded 2, and the other spouse has their full 6 million. So you've used up 8, you've safeguarded 2 extra, and the other spouse has 6. If they each put in 4 into their own trust, they have a total of 4. They've lost exemption. You haven't helped. So just make sure the plan makes sense. And like I tried to illustrate, if asset protection is the primary goal, maybe. Here's the exception. A lot of times what we'll do is we'll do a simpler slat for one spouse. Let's say that the couple's worth $25 million and they can use, they feel, and they've had some financial modeling done and they've reassessed their insurance, which we're going to come to. But let's say they've put in $10 million out of $25 million. That's a big percentage of their net worth. One spouse, let's say husband, sets that up. I'll set up a less costly, maybe not in a DAP jurisdiction, slat for let's say the wife. Why? Because we may buy insurance on the wife's life to help protect the husband. So if the wife dies prematurely, there's money in a trust for her. So we may do an inexpensive home state slat. So we have two non-reciprocal slats, but it's not your traditional slat plan where they're each using lots of exemption. One's holding only insurance. So if there's a premature death, the settlor spouse of the trust with the big dollars is protected. And we'll come back to some of those concepts in a minute. So that's important to think about. Now, third key point, and Jonathan, I'm going to get you there real quick and then turn it over to you. You gotta preserve access. If a client is worth $50 million and next year you can put in $26 million into two slats, roughly $13 million per client. I'm estimating it's a little lower, but call it 13. That's over half of their net worth. That's huge. Can they afford to give up access to that? Probably not. If one spouse dies prematurely, or there's a divorce, or there's another issue, will they have enough resources, each spouse, to maintain their lifestyle expenses? The way to really do that is you got to partner and collaborate with the wealth advisor to do some financial modeling. You got to bring in, and we're going to get to it in a second, the insurance consultant to fill some of those gaps. The way to address it is to analyze it and to preserve access. Now, Jonathan's going to talk, and I'm going to get him there in a minute, about ways you can draft for this, and that's critically important, but there's other aspects. I illustrated the mortality risk already. So let's say husband puts 10 million into a slat, maybe wife's has a simpler home state slat. It's really an islet, just a simpler trust to own an insurance policy on her life. Maybe it only has 5-year, 15-year term. Maybe the financial forecast and modeling shows that's all that's needed, because at that point the husband's old enough, he's not going to need more money than he has in his own name outside of the slat. But you want to make sure to fill those gaps. Another key point, if you've done slats, we all did tons of them in 2020 and 2021, encourage clients to have an insurance consultant come in and look at these financial soft points or gaps in the planning. It's inherent in slat planning. So if there's a premature death, is there insurance or some other ways to access it? In a lot of cases, it's not. If the client appreciates that and buys the insurance, problem solved. If the client is shown by an insurance consultant the modeling, the financial reasons that life insurance on one spouse's life is necessary or advisable to fill that gap, and they don't buy it, then it's not on you as the advisor. You identified the problem through the help of the insurance consultant and gave them a solution. So get the client's wealth advisor if they do it, or an insurance consultant to do it. Disability long-term care, same concept. Client's 50 years old, doesn't need disability insurance. They got $20 million in the bank. They're fine. Well, maybe they are, maybe they aren't. A lot of it depends on lifestyle expenses, burn rate, et cetera. I'm not going to get into the details. The financial advisors and wealth advisors can help you with that. But the point is, if they just go and put, $20 million, $10 million into each of two non-reciprocal slats, even though they have access, and Jonathan's going to tell you how to give them even more access, psychologically it's different. I think if you put in 50% of your wealth into a trust, having the insurance also may help deflect a fraudulent conveyance claim, because you've addressed these financial issues. Having the analysis that the insurance consultant or wealth advisor does to show that you've addressed these life risks that are there and that you've planned for them, I think bolsters the plan. You didn't need an implied agreement in the event of early death or disability because you planned for it. Long-term care coverage. A lot of clients that said they didn't need long-term care coverage, I said, talk to somebody. I don't do it. I don't understand it. It's not my thing. Talk to an insurance consultant. Let them try to sell you. I'm not telling you to buy. Just listen to the sales pitch. A lot of them have bought it. Why? Even if, because they have access to the slat, they don't need it, they feel, if you will, psychologically insecure because they just gave away 50, 60% of their wealth into these trusts. They like the idea of knowing that if, God forbid, they get sick, they have the care. Really valuable. And as I point out at the bottom of the slide, it's also very helpful. Jonathan, we don't really have time to get into it. So unless you want to talk about it, because we've done other programs and we need to do a program on it, lots of ways to add lots of beneficiaries to trust, not, floating spouse clause, broad class of beneficiaries, which can indirectly accomplish things that the settlor needs as well. Trust protectors, I'm going to skip. What I want to get to, loan provisions are critical, not just for grantor trust status, but to provide access. Now, Jonathan, let me turn it over to you and give you some time to talk. Um, we don't have to do just two non-reciprocal slats. We could do a spat and adapt, or a spat and a hybrid dap. Why don't you explain what these concepts are for those that aren't familiar with them, and why they not only break the reciprocal trust doctrine, but apropos to our third topic here, give more access, which is absolutely critical.
Well, remember, I've already started by saying we are trying to accomplish a number of things. One is we want to use remaining exemption. Number two, we want to make sure that the couple has access to the property. That's kind of critical, and we want to make sure it's excludable from their estates, which is what you're trying to do. So again, typical husband and wife create trust for each other. You hope they're not going to be reciprocal in a tax or a creditor sense. But there are other things you can do. One is let's say that the wife is the wealthy one, as it is in the case of Marty's family, where Marty goes ahead and he says to Patty, gee, why don't you create a trust for me? And she goes ahead and creates a $10 million, or maybe she takes her total $12 million exemption amount and puts it in a trust for Marty. Marty presumably will have a power to appoint it back and for the trust for Patty when he dies. So Patty feels somewhat comfortable. But Marty may not have enough money to do it for Patty, or maybe they just don't want to run the risk of reciprocal trust. Well, one of the things that Patty could do is she could go ahead and create a trust for herself. She could create, now Marty has created it, but now we've used her exemption, but now we want to use Marty's. So Marty says, I'm not going to create a trust for Patty today. We're a happy couple. We're not worried about, somebody losing confidence in the other to take care of them. So I'm going to create a trust for myself. Patty's created one for me, and I'm going to create one for myself. Well, again, there are at least 18 jurisdictions in the United States where you can create a trust for your own benefit. And if you're not trying to bilk a creditor, that trust should not be subject to the claims of your creditors. And unless you put in some additional powers, it will not be includable in the grantor's estate. So Patty creates a $12 million trust for Marty, and Marty creates a $12 million trust for himself. You don't have to worry about the reciprocal trust doctrine because you haven't created, a cross trust for either spouse. So that's one of the things you can do. So you go to a solid domestic asset protection trust jurisdiction, whether that's Alaska, South Dakota, Delaware, Arizona, a number of states now have them. I think Connecticut may be the most recent. And you can take a look at those and you just do one for yourself. And you don't have to worry about using different trustees. You could use the same trustee for the trust that Patty creates for Marty and the trust that Marty creates for himself. So that's one of the things you can do. The second thing you can do is create what's called a hybrid DAP, where you create a trust, but you say, I'm not a beneficiary, but you become a beneficiary at a later point in time. Maybe after 10 years and a day, because there's kind of a special 10-year rule in the bankruptcy legislation that maybe you say, I've created this trust, but I can't be a beneficiary for more than 10 years. Or maybe you put it in, I can't become a beneficiary unless my net worth had dropped to below a certain level. But you can put a lot of conditions in that, and that reduces the risk of creditor access, which reduces the risk also of estate tax inclusion. In addition, you can do, and that's called a hybrid DAT. It's not a DAT at the beginning, not a domestic asset protection trust, but it becomes one at a certain point of time, either by somebody. You can say it's automatically after 10 years and a day, or you can say when your net worth is followed, or if you get divorced from your spouse, that's one. And let me add one other thing. As I've stated, most of these trusts you'll create for your spouse are going to be grantor trusts with respect to you. Well, it's going to be very bitter if you create a trust for your spouse and you and your spouse have a falling out and get divorced, and it's going to continue to be a grantor trust with respect to you. Even though your spouse is no longer your spouse, the repeal in 2018 of Section 682 means that that trust that Patty created for Marty, which was a grantor trust with respect to her, will continue to be a grantor trust with respect to her, even if she and Marty get divorced. So one of the things you want to do, and you've got to talk this through with your clients, and a lot of them are very resentful that you'll even raise the question of divorce because theirs was the one marriage made in heaven, it'll never end. But just you can talk about it hypothetically, that, if there's something happened and there is a divorce for whatever reason, you don't want grantor trust status to continue for you. And then what you've got to do is either eliminate that spouse as a beneficiary, so the trust that Patty has created for Marty would be out if they get separated or they divorce, or you can say that the trustee can make distributions to Marty only with the consent of an adverse party. Now, we could spend an hour on that topic alone, but please take that into account in drafting any trust that you do that's going to be a slat or a slat type trust at there. Now, the other thing that you can do is, again, Patty has created this trust for Marty. We want Marty to use his exemption. Marty can create what's known as a SPAT, a special power of appointment trust. This is a concept which Mitch Gans and Abby O'Connor from Anchorage and I wrote up, and you can read all about it in the February 2019 issue of Estate Planning Magazine. And I think it's really a great idea. In fact, I think it's better than a standard DAP, because you create this trust and you say, okay, I'm not a beneficiary. So Patty creates this trust for Marty. Marty creates a trust, and the trust says, Marty can never receive a distribution, ever. It's just prohibited. Well, it can't be in his estate because he's not going to have any access, even if somehow a creditor or the IRS said the reciprocal trust doctrine should apply. There's no way that that can be includable in Marty's estate because he is prohibited from ever receiving a distribution. So how does he get access? Well, he gives his 3 most trusted friends a special lifetime power of appointment to appoint any of the property in that trust that he's put in there for his family. Remember, he's not a beneficiary. He can never receive a distribution from the trustee on a discretionary basis. But his 3 best friends, any one of them can exercise this special power of appointment that Marty has given them in the trust to appoint any part of the property to any descendant of Marty's mother. So if Marty falls on hard times, he goes to Tom or Dick or Harry or Susie or Joanne or Mary and says, I need money. Would you please make a distribution to me? Now, if Marty has picked, some of the right people, at least if he's got a real need, probably one of those 3, and that's all it takes is one of the 3, will go ahead and make a distribution for Marty. That special power of appointment trust, I think, is the cat's meow. And I think it really beats ADAPT, which is a concept, of course, I created back in 1998. But I think that the SPAT is a better one because you reduce the risk of creditor claims. You reduce the risk of the IRS claiming that it comes into the estate because you have no access except by someone having a special power of appointment which they can exercise in favor of any descendant of your mother. Now, suppose Marty's put in me and I say, I'm mad at Marty. He beat me at bridge, or he did a better job catching salmon than I did. So I'm going to screw Marty I'm going to appoint all this property to Marty's children, and Marty is going to be out. Well, the condition, however, is that the 3 of us who have this special power of appointment can only exercise it with the consent of Marty's lawyer. So I think if I go to Marty's lawyer and the lawyer quizzes me and says, you're doing this because you're mad at Marty, Jonathan, I'm not going to permit you to exercise that special power of appointment. So I think this is a good idea. By the way, Marty mentioned, interactive legal. There's a great SPAT form on there, but you can read all about it. And I think you should read about it in the February 2019 issue of Estate Planning Magazine, because as Marty said, you can offer more options to your client. And I think you will find that a number of clients would say, hey, that's pretty good. I trust my 3 oldest cousins. I trust my roommate from college and my best friend from high school and my golf buddy. I'll give it to them. And you can have successors come in if someone dies or just goes crazy. But that's going to really provide protection, and it should work in any state, even New York and California, which are 2 of the worst states for self-settled trust. But it should be protected there, but still create it in a DAP jurisdiction like Alaska or South Dakota.
Jonathan, let me ask you a question. Practically speaking, some clients are going to say, you know what, great idea. I really like the DAP, hybrid DAP, SPAT. but you know what? I don't want to spend the money now on an institution. I don't want to spend the money on local counsel. I don't have that much wealth, but I really like the idea. Can you set up the trust in New York, non-DAP jurisdiction today? Leaving aside the rule against perpetuities because it's not as favorable, but we're not concerned about that. And I'm going to give you the power as trust protector to pull the plug and move the trust. Fire Aunt Jane, who's the trustee, name Peak Trust as the trustee in Nevada, and change governing law in Citus. Will that suffice? And then after that, my college roommate can pull the trigger and add me back as a beneficiary or exercise the SPAT power. So bake everything in, but keep it less costly today and move it later.
That probably works, Marty. But again, I think you're much better off. I mean, you probably know someone in one of the 18 DAP jurisdictions, whether it's Connecticut, New York, Hawaii, for example, someone who can do that trustee. By the way, that trust is going to be a grantor trust, so you don't have to worry about state income taxation. But think it through carefully. But yes, Marty, you could set it up, say you're a New Yorker, you could set it up in New York, and then later you could move it by, having it have the jurisdiction moved, or even by a decanting.
So I want to give options because for some smaller clients, that's not going to be feasible. They're just not going to be able to find the cost of doing it in a trust-friendly jurisdiction, hiring an institution, some of the things we've talked about palatable. But what I'm trying to give to the practitioners, you can still bake this stuff in so the options are there for later, which is great for the clients. You may be able to add some of this by decanting, but I think showing that you've baked it in will remind people if bad stuff's about to happen, like a lawsuit, something happened, or they've just hit on some new money. You got it baked in. I think it's a great way to be able to bring this down for more people. Keep in mind the other example I gave a little while ago, where sometimes one spouse and I hate to use the word moderate wealth when somebody's worth $25 million, but relative to a $12 million exemption that's going to be close to 13 million, 25 million is moderate, and maybe using one spouse's 12 or 13 million exemption is all they can stomach. They may not even be comfortable doing that. They may want to do 10 million, not even the 12 million they can do today. So you do a less costly home state slat for the other spouse to hold insurance. You can bake in SPAT provisions. The inexpensive slat that I mentioned doesn't have to just be a simple ILIT or home state slat. It could be a home state slat with a trust protector. That doesn't cost anything to name a friend as a trust protector that can move the governing law status and change trustee. You can bake in a DAPT or a hybrid DAPT or SPAT provision that can be only exercised after it's moved to a DAPT jurisdiction. So you can give a very robust, sophisticated trust for not a lot of money. So if you have a wide range of different clients, you can mix and match and really come up with some creative stuff that does a much more robust job for the client. And that was kind of the point, one of the key points of this whole program on slats, is that you can do much more robust slats. Bake in a loan provision. We gave you sample language. Have a robust trust protector provision. Look at the SPAT and hybrid DAP provisions that Jonathan mentioned, even if they're not comfortable doing a DAP today. What a great way to differentiate from the reciprocal trust doctrine. What a great way to give access. And listen, if we find that the law is not changing, and as we get to the end of 2025, and we're going to see the exemption going down in 2026, we're all going to be deluged with clients trying to use exemption. Deluged. These are powerful tools that can help us. Jonathan, I think we can make some wrap-up comments. Let me just go through these two slides real quick. So keep in mind that, sorry folks, loan provision, adding charitable beneficiaries. It's not only very important to add flexibility, it's very important if down the road you convert to a non-grantor trust status, or after death it has to become a non-grantor trust. If you don't have charitable beneficiaries in, you have a governing instrument issue and won't get a charitable deduction, bake it in, but also bake it in because it's another indirect means of access. I can't use a trust I set up for my wife and descendants a Slat to discharge a charitable pledge of mine. But if I can have charitable beneficiaries in there, it can be used to make charitable gifts that we want to make anyhow. So it's another indirect, if you will, access, because maybe I won't make a charitable gift. The Slat I set up for my wife will have homes or vacation homes, at least bake in the provisions permitting personal use. One of the things to keep in mind when you do that, who makes a decision about buying a vacation home? Is that an investment advisor that may be the client? Is that a distribution trustee decision that may be the institution? Think about some of those things. Tax reimbursements, I've seen them done wrong a lot of times. A lot of times I only find out about when you talk about poor administration. Client took tax reimbursements, never asked anybody, they just did it. How they did it, I don't even know in some cases. You want to have an analysis by the client's accountant, the team approach, right? So that there's backup for why the trustee made that payment. I've seen awful things where tax reimbursements were made. I don't know how the institutions made them, but they did without any backup showing what the tax cost was that was being reimbursed. So bake all these things in, but make sure they're administered well. Get the team involved. You need the team, you need the insurance, you need the protection, and there's lots of great things to do with asset protection. We've really covered the asset protection concept, so I'm going to just mention a few points that I like to do. And Jonathan's comments about DAPs and hybrid DAPs and SPATs is a big part of this. I like using trust-friendly jurisdictions all the time. I refer on the bottom of 69 to what I call a creeping slat. The idea is whatever type of trust you set up, and I've used this for myself. I set up a self-settled trust. And Jonathan, what did I tell you? 1998, I think it was within 6 months of the law passing in
I
Alaska.
think that's right.
I just thought it was a fascinating concept. And I didn't have much money, but I didn't have to pay my lawyer much. But you know what they say when a lawyer has himself as a client. But I set up Adapt in 1998. I put in peanuts back then because I didn't have a lot of money. In 2012, I put more money in because the exemption was going to go down. More recently, I put in some more money. It's hard if somebody makes contributions, gifts over time, or transfers over time. It's much harder, I think, to argue there's a fraudulent conveyance. So let's say you have a physician client, worried, a surgeon, right? So there's always liability issues. And they want to put in $12 million in a Slat before the end of 2025. You could actually put in $3 million in 22, $3 million in 23, $3 million in 24, $3 million in 25. None of those are large portions of their wealth. Yes, the problem is more wealth is subject to a potential claim before it gets in, but think of what you've done to deflect a fraudulent conveyance. Planning for clients that are concerned about liability, which should be almost all of our clients, right? Even when they don't have a lot of money, you can get the trust set up locally, put some money in it, move it to Nevada or South Dakota years from now, and make gifts over time. So that's very helpful. A couple of last comments. Obviously, you should tie in entities. Here's a couple of points. One of the things that I like to do is some due diligence when we make any large transfers, not just self-settled trust, but a client setting up a Slat wants asset protection. You can do internet searches, you could do LexisNexis searches. What we've opted to do, because I think it's actually less costly for the client, I think it's much more objective looking. I'll give you the name Raymond. It's a large Midwest accounting firm that has a whole forensic division. And what they'll do for a fairly, what seems to me, modest amount of money is they'll do lien and judgment searches, criminal record searches, credit card history searches, on and on and on, and issue a written report. I think it's very credible to have an independent firm generate an analysis to show that there were no issues that came up to go undermine the transfers that are being done. Having the wealth advisor do economic forecasts is not just great to see and deflect an implied agreement to show the client if there's a financial need for insurance or something else. What a great way to deflect a claim by a creditor that it was a fraudulent conveyance. What fraudulent conveyance? Here's a detailed Monte Carlo simulation my wealth advisor did. I shouldn't need this money for 30 years. Or whatever it is, lien and judgment searches. We have, and I'm going to wrap up in a minute, so just bear with me, everyone, because we're right on about the 90-minute mark. I have an affidavit of solvency done for a large portion of any of the more material or large transfers. Why? If you're doing Adapt in Alaska, the statute requires an affidavit of solvency. How hard and costly is it? half an hour work to take a template form for an affidavit of solvency, modify it for the client and have them sign it. Think how protective that is to the client. If there's a later claim by somebody, they signed under penalties of perjury. They weren't aware of any claims other than maybe the ones they listed. And by the way, if they list a claim, you may want to exclude that from the protection of the trust as well. I like using an institutional trustee. We've had that discussion. To me, these are all ways to make a SLAT plan. And now you should be not thinking SLAT, but SLAT, DAPT, hybrid DAPT, etc., with lots of different robust provisions, safer from an asset protection perspective. And I think it also protects us as practitioners, because if you do all this due diligence, not only have you better protected the client, which they should appreciate, but now you weren't involved in a fraudulent conveyance. Jonathan, before we wrap up, and I'll ask you to say any last comments, maybe you can quickly just tell the horror story of a colleague of ours, I think from South Dakota, I may be wrong on the state, that got some problems from making transfers to a trust for a client. Do you remember
Well,
that situation?
it wasn't South Dakota, it was another state, but the lawyer had a client who came in and asked him to assist in a fraudulent transfer. The lawyer refused smartly. But the client then did a bunch of things on his own. He came back and said, look, I've done this on my own. All I want you to do is basically file these deeds. And the client certified to the lawyer that it wasn't fraudulent at all. Well, it turned out it was fraudulent, and the lawyer almost got disbarred. It had to go to the Supreme Court of that state for him to retain his license. So you've got to be very, very cautious when you have a client come in. I mean, I've refused to help people who call me, and I can tell that they were very anxious for asset protection because they knew they had a problem. Don't go there. It's just not worth the money. Send them to somebody else, but don't do it yourself.
That's why some of these precautions not only protect the honest client, but they protect you as a practitioner from something like what Jonathan just described. Jonathan, any concluding remarks, and then we'll wrap up?
I think we can wrap up, Marty.
So I want to thank everyone for joining us. Hopefully this was helpful and practical. I hope we've given you a lot of practical tools to help improve the administration of existing SLATs and other trusts. I hope we've given you a lot of useful, practical, actionable ideas to do more robust DAT, SPAT, hybrid DAPTs, and SLATs going forward. A lot of practical insights on how to administer trust properly. There's a lot of material in the PowerPoint that we didn't get to. And if Jonathan and I can help, and I'll speak for Jonathan in this regard, let us know if there's a specific issue that you have questions on. One of us may have written an article or have another PowerPoint or presentation on it we can send you. So I wish you all good luck, and I thank you all for joining us, and be well and be careful.